Money Show.
Personal Finance with Warren Ingram.
Welcome back to the Money Show, getting into personal finance. Now, earlier on, I promised you a 10-year plan of looking where to spend your stock market money. That is what Warren Ingram, the co-founder and of Galileo Capital, personal finance as well, that he does here on the Money Show, is going to be talking about tonight, looking at what exactly you should be spending on in terms of the stock market, where your money should be going in the next 10 years. Now, this is not an easy task, but I'm telling you, some advices you want to take for free here on the Money Show. Warren, welcome again to the Money Show. A very important conversation, one that a lot of people have over dinner, at work, over lunch, to say, where are you putting your money? Is it, the New York Stock Exchange? Have you moved on to London, or maybe Japan or Hong Kong or Euronext, or you're staying on the JSE? Where are you putting your eggs next? Is what everyone wants to know, at least for the next 10 years, once we are past all of this volatility that we've seen on the market. So when one puts their basket together of goods and they want to send their money for returns, where exactly should they be going?
Motheo, for the show, I went to my cupboard and I went right to the back and I got my little crystal ball and I polished it up and I had a deep look inside that crystal ball to give me an answer. And I think maybe the first thing to say is we like as humans, we always think about the recent past and think that that's what's going to happen in the future. So, when it was raining yesterday, we kind of think it's probably going to rain tomorrow. And when whatever the stock market is, if it's the JSE was up last year, we think it's probably going to carry on going up next year. And that's, the psychologists call that recency bias. And it's a very strong thing. And what we need to know about markets is they move in big cycles, so they go up and down every day like a rabbit, going crazy. But when you zoom out a little bit and you have a look at the markets, over longer periods of time, you realize that they move in very big cycles. And what's happened over the last decade, is we've seen the US absolutely delivering fantastic returns, way better than pretty much every other major market in the world. And on the other end of the spectrum, as we all know well in South Africa, we've seen emerging markets do very little and kind of take actually a lot of pain a lot along the way. So why the history lesson is because we need to be very careful to say, well, if the US was the place to be over the last decade, and in fact it was the last 3 decades, then it must be the place to be in the next decade. And emerging markets were lousy, so let's not put our money there. We should rather put it somewhere else. And I think that's going to be a mistake going forward over the next decade. So that was the history lesson, Motheo. And I think going forward, I think we've got to look at investing a little bit like driving a car. If you're driving a car on the highway at 120 k's an hour, what you should really be looking at is, out the window, the front windscreen. Please don't spend all your time looking in the rearview mirror, because that's a great way to have an accident, when you don't realize that someone stopped in front of you.
But someone might say to you that, looking in the rearview mirror, because over the past few years, I've enjoyed some gains from particular markets, and I still feel that I should be staying there going into the future. That's why you might see one eye is on the rearview mirror and the other on the road.
I like it. I think that's not a bad idea at all. I think the one thing we need to be humble enough about investing is to know we can't make a solid prediction. You and I have chatted about this a few times already. You can't predict the future with any confidence. So if we're looking at the past and we say, well, the US was a great place to be, then I'm certainly not saying tonight, take all of your money out of the US and move it elsewhere, because, the US could continue to deliver for another year or 2 or 3 or maybe even longer. But what I would say is be careful of being overinvested in the US. Rather reduce your allocation and look at the other markets that are a bit cheaper. And I think that, there's 2 kind of big drivers in this. And one thing is, the US dollar on any measure is very expensive. And I know we think this is a South African thing, that the rand's weak and it's all about the rand. But it's not. The US The only time it's been more expensive than it is now, the US dollar, is in the early 2000s. And when it started to fall, it lost nearly 40% of its value. So if you're going to take a chunk of your money or all of your money and put it in the US stock market, and the US dollar loses 40% of its value, that means your stock market investment has to do at least 40% just to stand still in any other currency. And that's a heck of an ask for an investment. So that's my first big comment, Motheo, is we've got to be careful about the dollar. And then we've got to be careful about the value of the US stock exchange. It's expensive. It's probably 25 to 35% more expensive than the rest of the world's stock markets put together. And this is a bit like saying, I want to kind of, build a building, and you're already right at the top of a building. It's impossible to go higher when you're at the top of a skyscraper. You want to start at the ground and build a skyscraper from the ground up. Then you can build yourself a really tall building. And I think that's the issue we've got, is very expensive dollar, very expensive US market. So I would be looking at the rest of the world and saying to myself, emerging markets have done nothing for a very long period of time. They've got great educated population working hard, great demographics, and their currencies are cheap. Their markets are cheap. We need to increase our weighting to those and decrease to the US.
Someone might say, although it comes at a premium and it's expensive, looking at what tech shares are doing in the US, people are crazy about Nvidia, are crazy about Microsoft, Amazon, all those tech giants that seem to bring very great returns if you've invested in them. So someone might say, I'm willing to take the risk. I'm willing to take a portion of our money to the US, expensive as it is, with the bet that when it does return in dollars, and I'm sitting in a good position.
Yeah, I like your phrase there. It's a bet. It's not the thing about investing is I want to take a calculated risk, and allocate money where I believe I can buy something that's relatively cheap and that it's going to deliver growth over a long period of time. But buying Nvidia, might be the best chip maker in the world. It might be, it might have the perfect range of products, with a huge competitive advantage over every other chip maker in the rest of the world. But the share price of Nvidia is ridiculously expensive. So what needs to happen for you to make money out of Nvidia is the company needs to deliver fantastic growth year after year after year for the next 70 years to justify the price today. Nothing does that well for 70 years. That's not possible.
Then looking at some of the options that you were talking about in terms of emerging markets where people can invest their stock market money there, those that you see as growth opportunities going into the next few years.
Yeah, I think we've got to be very careful to be too specific in terms of saying, we think that the reforms that have happened in India have really been fantastic, and that's going to be the only growth story out of emerging markets. It is my view that India is a great place to kind of look at, and their economy is going incredibly well because they've done some great reforms. But again, I wouldn't go and allocate all of my emerging market money to India. I would allocate a portion, and I think. Don't be scared in a situation like this to take a portion of your money and just buy the emerging market index, where you get a really nice spread across a bunch of emerging markets. And then our little old JSE, which has just been getting hammered, for a long period of time. And we see so many companies delisting and no one's writing good stories. There are a bunch of companies that are really cheap on the JSE that have done, it's almost like Darwin at work. We've got companies that have struggled with enormous economic headwinds, with no political help, just everything going wrong, and they've survived. So the moment they get another 100 or 200 days of no load shedding, and they get a bit of economic growth and maybe a bit of help from Transnet and all those things, watch how these incredibly fit, incredibly well-managed companies start to deliver real profits. And if you've got all your money in Nvidia, you're not going to participate in that growth. So I think you have to have a bit of, SA exposure as well. I think it could be a very good call over the next decade.
We'll continue to talk strategies into the next 10 years, at least in terms of investing your stock market money for the next decade. In our personal finance feature, Warren Ingram, the co-founder of Galileo Capital, currently dropping us some gems.
The Money Show.
Personal Finance with Warren Ingram.
Personal finance, and tonight we're talking where to invest your stock market money for the next decade. Before we went on break, we're talking about emerging market indices that indices you can go into and invest your money. Of course, the best strategy there is not to place everything in one basket. I'm sure that particular saying was not meant for the stock market, but it seems to work well here. What type of strategies are you applying then in the next 10 years? Yes, the US is what it is. It's a beast. It has some returns, but also quite expensive. Emerging markets are also an opportunity, but how do you make sure that you've equaled everything out enough for you to have a well-functioning portfolio for the next 10 years?
I think it's about being a little bit nuanced in your views. And in other words, if we think that the US has some of the best run companies still, and especially around the globe, you talked about Microsoft, and it's not nearly as expensive as Nvidia, but it is expensive. And a company like Microsoft will sell a huge amount of services to companies and countries far away from the US. And so, it's not a bad thing to have exposure there, but equally that, the small and medium-sized companies in the US haven't attracted a lot of investor interest because it's all been sucked up by the tech shares really, and maybe a few other big financial services businesses. So, I think, allocating some money to the US market is fine, but then add a little bit extra to the small and medium-sized businesses in the States. And again, you can do it either through a unit trust or an exchange-traded fund. There are lots of exchange-traded funds that will allocate money to those small and medium-sized companies. And then equally, look at the rest of the world. I think the UK is an absolute mess. I don't know how they're going to get themselves out of their troubles, but that doesn't mean that they don't have some very good high quality businesses in there that operate around the world. So having some money to, expose to the UK and then right across Europe, all the way through China into Japan, I think makes sense. For me, I'd probably allocate a little bit extra to Japan. I think that's a stock market that's going to do well as well. And then we've spoken about emerging markets, and if you can, maybe slightly overweight, India. And then my tip for the decade will be, maybe a slightly bigger weighting than what the index allows for South Africa. I think we're in the beginning of a nice story for the next decade. And people won't remember, Motheo, but in the early 2000s, after the IT bubble burst, the JSE far outperformed the American stock market for a decade. And it's possible that happens again now. We need to be careful that we think that the JSE will just go nowhere.
While local still remains lacquer in terms of stock markets as well into the next 10 years. So do keep your eye on the JSE. But I wanted you to roll it back a little bit and explain what troubles you're seeing in the UK. Somebody might have been advised by a friend to go heavily into the UK, but you're seeing some red flags there.
If you talk about politicians shooting themselves in the foot at the expense of their country, that's called the UK. That little thing called Brexit, where they decided to remove themselves from the European Union, is turning out to be a huge disaster. So they are so worried about stopping immigration into their country that they're now in a situation where they don't have enough labor to do the work. So that means the cost of living is going through the roof. There aren't enough people to do all the jobs. The salaries are high. Energy costs are high. Their actual economy is growing not at all. It's stagnating. And they've got a huge debt problem. And there's no easy solution. They've just lost, the government that's been kind of running the country into the ground for the last decade or so is just been changed. Listening to the new government, I don't think they've got some, great ideas. They've got real problems. So they've got economic problems. They've got an old population that, a large chunk of whom live on social security and have no interest in working. So they've got a health system. Their version of NHI is called NHS, and it's creaking at the seams because there are not enough nurses, not enough doctors, not enough money. So they've just got a lot of trouble, Motheo, and they're that they used to be a superpower, and I think they still think they are, but they're actually a reasonably small economy now, and no real power. So I think they've got some good companies, but they act like they're much bigger than they are. It's a little bit like a Yorkshire Terrier that thinks it's the size of a Rottweiler. Eventually it just gets squashed.
It's like the rugby squad, I think. I think let's go then into somebody saying that they want to get into perhaps the US stock markets, and you've spoken at how much of a premium they come at. What are the strategies that can make it affordable for those trying to get some of that US exposure?
If you've got a reasonably small amount of money, you've got to be very careful about transaction costs and annual costs, because those could wipe out all of your potential growth. So I like the idea of just buying an index. So if you want to buy the biggest companies on the American market, there's an index called the S&P 500, and that's a very good way just to buy the top 500 biggest businesses with one investment. And you could, there are lots of trading platforms that allow you to do that with, kind of 500 Rand if you wanted to, or ideally do a bit more so that you mitigate those transaction costs. But I would say if it is your first investment, then maybe just buy the world index instead, because that's got about 60-something% exposure to the US, and at least you're getting the rest of the world as well.
We've got a question here, a listener question from Esther saying, I see that inflation rates are starting to slow down. What does that mean for my investments?
Happy days. That's what it means. If inflation starts going down and it gets to the level where reserve banks around the world are comfortable, it gives them the scope to start cutting interest rates. And interest rates, especially in the developed world, but even in South Africa, are really high now. And high interest rates are like a major break to economic growth and a huge cost that companies have to bear, because if they're running with some debt, then they're paying a lot of their revenue away to cover interest costs. So the moment that inflation comes into the normal kind of range for reserve banks to cut interest rates, that means that you now get, instead of having a break, you start getting a tailwind. You start getting a bit of extra money every month, which means companies invest more, individuals have a bit more money to spend, and so it becomes a very positive environment for especially shares, also property investments, and even bond investments, do better as well. So it's a really good sign. That's kind of the thing we're all waiting for, is for that first interest rate cut, especially in the US, but then, that'll happen around the world. Everyone else will follow.
Thank you so much to Warren Ingram, the co-founder of Galileo Capital. For most of us who didn't know where to start with this 10-year plan in terms of investing your stock market money for the next decade, I think we have some very, very good pointers, and we didn't even have to pay a penny for it. Thank you so much for that personal finance feature with Warren Ingram.